The Roundhill WPAY Universe ETF, ticker WPAY, is shaping up to be one of the most talked about weekly income products as we head into the end of 2025 and beyond. In my opinion, this fund has the potential to fundamentally change the way investors think about income-focused investing. WPAY launched on September 4th, and right out of the gate, it's already up 4.21%. It pays distributions every single week. Every Wednesday, investors can expect a payout. That alone makes this fund stand out because it matches the rhythm of how people actually live. Most bills, most expenses, most paychecks come weekly or bi-weekly. WPAY tries to mirror that real-world cadence with real distributions, but the structure is even more interesting. This isn't just a covered call ETF like JEPI, QYLD, or YieldMax's lineup. Instead, WPAY is a fund of funds. It spreads its capital across Roundhill's family of single-stock weekly pay ETFs. That means inside this one ticker, you're holding exposure to names like Tesla, Apple, Amazon, Google, Broadcom, and Meta. Each of those single-stock funds targets 1.2 times the weekly return of its underlying stock using swaps and flex options. In other words, WPAY is built to magnify weekly moves while still paying out distributions on a weekly schedule. Most income ETFs are built around giving you a steady stream of cash, but they achieve it by capping your upside. Covered call strategies collect premiums from selling options, but when the underlying stock goes on a big run, you don't get to participate in all of it. WPAY avoids that trade-off by not capping upside. Instead, it allows the gains to run, and with the 1.2 times leverage, those gains can even be amplified. In fact, just 1 week after launch, WPAY was already up over 4%, closing at $52.90 on September 11th. It's obviously very early, but that kind of immediate traction shows what's possible when you build a product around tech-driven growth stocks and layer on leverage. It's designed for investors who want to capture the next wave of growth while still having a portfolio that pays them weekly along the way. So what makes WPAY unique compared to the competition? First, the weekly distributions. This is the obvious selling point, but it's a big one. For anyone who's actually living off investment income, retirees, freelancers, or even investors trying to cover side expenses, a weekly payout schedule provides unmatched flexibility. It makes your portfolio feel like a job, giving you recurring cash flow that lines up with real-world spending. Second, diversification. Instead of betting on one stock, like Tesla or Palantir, WPAY spreads your exposure across 15 names, rebalanced every month. That way, if one company stumbles, the others can carry the weight. You're still getting growth exposure, but with less risk of one stock blowing up your portfolio. Third, uncapped upside. Unlike covered call funds that sell future gains in exchange for premiums, WPAY doesn't make that trade-off. If Tesla rallies 20% in a week, or Google pops on earnings, you get the full effect, amplified by the leverage. In an environment where tech leadership continues to dominate, this structure is a huge advantage. And fourth, the 1.2 times leverage. This may not sound like much, but it adds up fast. A 5% move in the underlying stock translates into a 6% gain in the ETF. When you compound that effect across multiple holdings, the upside can be significant, especially if tech continues to lead the market. But with all those strengths, it's important to talk about the risks. The 1.2 times exposure cuts both ways. Just like your gains are amplified, your losses are amplified too. That makes this fund more volatile than traditional income ETFs. From my own experience holding the single stock weekly pay ETFs, the leverage hasn't had as dramatic of an impact on both the upside and downside as you might expect, and I think the same will likely be true with WPAY. Let's take a look at how WPAY is already showing signs of outpacing YieldMax's ULTY in terms of total return. Since September 5th, both funds have been positive. ULTY has been steady, leaning more on its distribution with just a small bump in price. It did what it usually does, provide consistent payouts, but not much on the growth side. WPAY, on the other hand, has shown stronger momentum. The price climbed more aggressively, and at the same time, it still delivered income along the way. That combination gave investors something a little different, not just cash flow, but real capital appreciation too. Now here's where it gets interesting. On paper, ULTY is still flashing that headline forward yield of about 80%, while WPAY is sitting closer to 53%. But in practice, over this short time frame, It was WPay that outperformed in total return. The takeaway? Forward yield can be a flashy marketing number, but total return is what actually grows your portfolio. And right now, WPay is showing early signs that it can keep up, and even beat YieldMax's ULTY. So, where do I stand? I think WPay is one of the boldest new products in the income ETF space. It solves two problems at once, it gives you frequent, weekly distributions, and it doesn't sacrifice upside to do it. That's something covered call ETFs just can't offer. If you're bullish on tech, and if you're comfortable with leverage, this could be a really interesting option to consider. Bottom line, WPay is not the safest choice, but it might be one of the most innovative. If you want your portfolio to generate income like a paycheck while still participating in the growth of companies like Tesla, Apple, and Google, this ETF deserves your attention. Now I want to hear your thoughts. Do you think WPay is the future of income investing, or is it just another high-yield strategy that looks good on paper but struggles over time? Drop your comments below, and if you found value in this breakdown, make sure to like, subscribe, and hit the bell so you don't miss future updates.